Happy New Year! As China welcomes 2026, the country is not just celebrating a new beginning, but also ushering in a bold new era for its housing market. Today, January 1, 2026, China launches a major new policy, a sharp cut to the tax on selling homes, a move that could reshape the property landscape for millions. The government has slashed the value-added tax, VAT, on homes sold within 2 years from 5% to 3%. This reduction is designed to make it easier and more attractive for homeowners to sell, especially in a market where liquidity has been tight. This is a direct intervention to revive China's struggling property market, which has been a key driver of the economy for years. The real estate sector has long fueled growth, jobs, and investment, but recent years have seen mounting challenges. The move targets homeowners and investors who need to sell quickly, making it far less costly to do so. For many, this could be the difference between holding onto a property and being able to move on. In a market where property values are high, a 2% tax cut means thousands in savings. For families and investors alike, this could free up much-needed cash and encourage more activity in the market. The policy is also expected to help those who have been waiting on the sidelines, unsure whether to buy or sell, by injecting new confidence into the market. The policy is effective immediately, signaling Beijing's urgency to support the housing sector. It's a clear message that the government is willing to act decisively to stabilize the market. China's real estate market has been hit by debt crises, stalled construction, and falling confidence. Developers have struggled, and many projects have been left unfinished, leaving buyers anxious and the economy exposed. By lowering the cost of selling, the government hopes to boost transactions and restore stability. More deals could mean more completed projects, more jobs, and a healthier economy overall. The big question: will this bold tax cut be enough to turn the tide for China's vast real estate market? Experts are divided, but there's no doubt this is a significant step. The world is watching as China takes this calculated gamble, hoping that a fresh start in 2026 will bring new life to its housing sector and ripple effects across the global economy. The value-added tax, or VAT, is a consumption tax applied to goods, services, and in China, even real estate sales. It's a tax that's paid at each stage of production or distribution, but for most people, it's most visible when buying or selling big-ticket items, like a home. In China, VAT plays a unique role in the property market. When you sell a property, a percentage of the sale price goes directly to the government as tax. This isn't just a minor fee. It can be a significant sum, especially in cities where home prices are high. For every transaction, the seller must factor in this cost. It's not just about paperwork. It's a real financial consideration that can affect whether someone decides to sell at all. This tax isn't just about revenue, it's a tool to shape market behavior. By adjusting VAT rules, the government can influence how people buy, sell, and hold property. For years, the 5% VAT on homes sold within 2 years was designed to discourage quick flips and speculation. The idea was to cool down overheated markets and promote stability. If you held your home for 2 years or more, you paid no VAT, a reward for long-term ownership. This policy encouraged people to think of their homes as places to live, not just investments to flip. This system created two types of sellers: those who held on and benefited, and those who sold quickly and paid the price. Long-term owners, who were exempt, could plan their finances with more certainty and often felt more secure in their investment. Short-term sellers, on the other hand, faced a hefty tax that could eat into their profits or even turn a gain into a loss. The VAT became a major factor in whether people sold their homes, often locking them in for at least 2 years. Many homeowners delayed selling, waiting for the tax exemption to kick in. For many, the tax could mean tens of thousands of dollars, wiping out profits or causing losses. It wasn't just a line on a bill, it was a real barrier to moving or upgrading. The new policy lowers this barrier, aiming to unlock the market and encourage more movement. By reducing the holding period, more people can consider selling or buying without the fear of a huge tax penalty. It's a powerful lever, now being pulled in a new direction, one that could reshape the real estate landscape and impact millions of homeowners and buyers across China. China's real estate sector once powered a quarter of the nation's economy, fueling growth and creating millions of jobs. But in recent years, the market has faltered. Major developers like Evergrande have collapsed under debt, leaving unfinished buildings and anxious buyers. Confidence has been shattered. Buyers fear falling prices and incomplete projects. Sales have plummeted, and homeowners hesitate to sell, fearing losses. The market is now sluggish, threatening broader economic stability. The government faces a dilemma: revive the market without reigniting dangerous speculation. Too little action risks a crash. Too much could fuel another bubble. Beijing's leaders are walking a tightrope, seeking just enough stimulus to get things moving. The VAT cut is a targeted step in this delicate balancing act. It's designed to thaw a frozen market, not overheat it. The stakes are high for China's economy and for millions of families. The next few months will reveal if this move is enough. Here's how the new policy changes things for Chinese homeowners. Previously, selling a home within 2 years meant a 5% VAT on the sale price, a major penalty. For a $500,000 home, that's $25,000 in tax. This discouraged quick sales and locked people into their homes. Now, the VAT for short-term sales drops to 3%, a 40% reduction. Long-term owners, those holding for 2 years or more, still pay zero VAT. The change especially helps those who need to move quickly: job relocations, growing families, or small investors. By lowering the tax, the government hopes to unlock more listings and boost market activity. It's a clear signal: adapt to life's changes without a crushing tax bill. The goal is a more dynamic, flexible real estate market. The numbers may seem small, but the savings are real. Take Wei and Lin, a young couple who bought a $400,000 apartment in 2024. A year and a half later, they need to move for work. Under the old 5% VAT, selling would cost them $20,000 in tax. Now, at 3%, their tax bill is $12,000, a savings of $8,000. That's money they can use for a new home or relocation costs. For pricier properties, the savings are even bigger. A $1 million sale now saves $20,000 in tax. This policy puts real cash back in people's pockets. It makes moving for life's opportunities more feasible. For investors and homeowners alike, the lower tax is a game changer. The government hopes these savings will jumpstart the market. Why act now? China's property market is one of its biggest economic risks. Previous efforts, easier loans, government purchases, haven't revived confidence. The VAT cut is a more direct tool to boost sales and liquidity. When transactions stall, the market freezes, hurting everyone. Lowering the tax encourages more homeowners to sell, increasing supply and drawing in buyers. The policy especially helps those who bought recently, often at high prices, and now need to sell. By easing their burden, the government hopes to prevent forced sales and deeper price drops. There's a risk. The cut could spark new speculation. But with the market so weak, officials believe the benefits outweigh the dangers. It's a calculated gamble to break the cycle of fear and stagnation. The next few months will test whether this bet pays off. China's VAT approach is unique, but let's compare it globally. Around the world, governments have developed very different ways to tax home sales, each reflecting their own priorities and challenges. In the US, sellers of primary homes can exclude up to $500,000 in capital gains if they've lived there 2 of the past 5 years. This rule is designed to encourage long-term homeownership and reward people for investing in their communities. The US taxes only the profit made on a sale, not the total sale price, and focuses on long-term ownership. This means that most everyday homeowners rarely pay tax when selling their main residence, unless they've made a huge gain. In the UK, buyers pay a tiered stamp duty land tax, with higher rates for pricier homes. The tax is paid upfront by the buyer, not the seller, and the rates increase as the property value rises. The UK system aims to make entry-level homes more affordable and taxes luxury buyers more. First-time buyers often get discounts, while those purchasing expensive properties face steep rates. China's VAT, by contrast, taxes the gross sale price and uses the 2-year rule to curb speculation. This means sellers pay tax on the entire amount, not just their profit, unless they've owned the property for at least 2 years. The recent cut from 5% to 3% isn't a philosophical shift, but a tactical move to get the market moving. It's a response to a slowdown, aiming to encourage more transactions and boost confidence. While the US and UK focus on affordability and profit, China's priority is market stability. Each country's tax system is a window into what its government values most, whether it's helping first-time buyers, rewarding long-term owners, or keeping the market active. The VAT cut shows Beijing is less worried about speculation right now and more about ending the freeze. The government wants to see apartments filled, deals happening, and confidence returning to the market. Each country's system reflects its own economic priorities. These differences shape how people buy, sell, and invest in homes, and influence the broader economy. For China, the message is clear. Liquidity matters most right now. The government is signaling that it wants to see money moving and transactions happening, even if it means relaxing some controls. The world is watching how this experiment unfolds, curious to see if China's bold move will thaw its frozen property market and what lessons other nations might learn from its approach. The biggest winners are short-term homeowners, families needing to move, young professionals relocating, and those facing life changes. They're no longer penalized for selling within 2 years. Small-scale investors also benefit, as the lower tax makes quick sales more profitable. Real estate agents and property services stand to gain from increased transactions and commissions. More listings mean more business for the entire sector. Even buyers could benefit. More homes on the market means more choice and potentially better prices. A more active market restores confidence for everyone. The VAT cut is designed to lift all boats, not just a select few. The hope is a healthier, more flexible housing market for all. This VAT cut is a pivotal moment for China's real estate market. The reward, a revived housing sector and a more stable economy. If successful, sales will recover, confidence will return, and growth will follow. But the risk is real. Speculation could return, inflating prices and creating new bubbles. The challenge is to spark activity without fueling another frenzy. The VAT cut alone can't fix deeper issues like unemployment or slow income growth. Sustainable recovery will require more than just tax tweaks. China's era of runaway property growth is over. Careful management is the new normal. The world is watching to see if this delicate approach can deliver stability. 2026 will be a defining year for China's housing market.